You ever wonder how one seemingly small government decision can send massive shockwaves through the entire financial system? Well, today, we're unwrapping a fascinating puzzle from 2001, a story of how the disappearance of a single financial tool created a huge crisis for America's biggest companies. Let's dive right in.
So, this is the big question, right? What happened here wasn't some dramatic front-page news stock market crash. It wasn't a housing bubble bursting. Nope. This was something much, much quieter. Almost invisible, really. But its consequences? Oh, they rippled out for years.
It all kicked off with a simple press release. The US Treasury thought, it could manage government debt a little more cheaply using shorter-term bonds. So they announced they were going to stop issuing something they've been issuing for decades, and something the entire financial world really depended on.
And that's something? It was the 30-year Treasury bond, what a lot of people in the business just call the long bond. And its sudden vanishing act is where our story truly begins.
Now, to really get why this caused so much chaos, we have to understand why this one specific bond was so incredibly important. It wasn't just another government IOU. It was, for all intents and purposes, the financial world's ultimate measuring stick. The 30-year Treasury bond was what's known as the risk-free benchmark. Think about it. It's backed by the full faith and credit of the U.S. government, so it was seen as pretty much the safest long-term investment on planet Earth. Everything else, literally every other long-term investment, was priced in relation to it. In this quote right here, it just hits the nail on the head. When you take away the one reliable yardstick that everyone uses to measure long-term value, you're not just making a small tweak. You're messing with the very foundation of financial planning itself.
So what was built on that foundation? Oh, just, the little things, like your pension, your life insurance policy, the 30-year mortgage on your house, even the debt that huge corporations use to build new factories and innovate. All of it, every single one, was priced using the 30-year bond as its starting point.
You could say it was the financial system's North Star for navigating the future. And then, in late 2001, the Treasury just switched it off. The first consequence wasn't some slow burn problem. Nope, it was an explosion. It triggered what traders call a short squeeze, a frantic, high-stakes market event that happened almost instantly.
And it all went down so fast. The second that announcement hit the wires, every single existing 30-year bond became a super rare commodity. Everyone who needed one, or worse, had bet against them, was suddenly scrambling to buy from a supply that was shrinking by the second. And you know what that does? It sends prices through the roof.
The scale of that price spike was just wow. The bond gained over 5 points in a single day. Now, to put that in perspective for you, that is a massive move for the bond market. We're talking about its best day in nearly 15 years. And all of it was triggered by a simple policy change. It's just wild.
And like in any big market shock, you've got your immediate winners and losers. If you just so happen to be holding on to those bonds, well, congratulations. You basically made a fortune overnight. But if you were a short seller, someone betting that prices would fall, you got absolutely crushed. You were forced to buy back those bonds at ridiculously inflated prices. Ouch. But here's the thing. The real damage wasn't done to some day traders on Wall Street. That immediate squeeze, that was just the opening act. The main event was a much slower, deeper crisis that hit the very bedrock of corporate America, their pension funds.
So yeah, while the traders were all dealing with the chaos of the moment, a much larger, more systemic problem was brewing away inside the balance sheets of the very companies that manage retirement funds for millions and millions of Americans.
The biggest victims here by far were pension funds and life insurance companies. Just think about their business model for a second. They take your money today and promise, hey, we'll pay you back, with interest, decades from now. To do that safely, they need to invest in safe, long-term assets. And the 30-year bond? It was their absolute perfect tool for the job.
This whole situation created this bizarre paradox. So follow me here. First, the few remaining bonds became so rare that their yields dropped to these crazy, artificially low levels. Okay. Then a weird accounting rule forced pension funds to use that unnaturally low yield to calculate all their future promises. And here's the catch. A lower yield makes your future promises look way bigger on paper. This created a massive phantom deficit that companies were legally required to fill with real cash.
And the impact was very real.
This accounting quirk basically inflated pension liabilities overnight by an estimated 12%. That is not a small rounding error, folks. We're talking about a multi-billion-dollar headache that directly hit corporate earnings and their cash flow.
The experts saw this all happening in real time. Actuaries, the people whose job it is to calculate this stuff, they were sounding the alarm bells. They warned that companies were being forced to make these huge, totally unnecessary cash payments just to cover a problem that was created entirely by a government policy decision.
So after all that chaos, what was the big lesson learned? And why did the 30-year bond eventually make a comeback?
Well, after years of this market distortion and a whole lot of pressure from pension funds and the wider financial industry, it became pretty clear that a mistake had been made. The Treasury finally reversed its decision, and in 2006, 5 years after it disappeared, the 30-year bond was back.
And the reason they brought it back was simple. The experiment had failed, miserably. The market proved that it desperately needed that long-term, risk-free benchmark to function in any sort of predictable way. It was just too critical to the entire architecture of the financial system to pretend it wasn't. So what's the big takeaway from all this? At the end of the day, this whole episode is a powerful reminder that these seemingly small technical decisions can have enormous unforeseen ripple effects. Financial markets are like incredibly complex machines, and they need stable, reliable parts to work. When you just yank out a key piece, you don't get more efficiency, you get chaos.
Thankfully, the 30-year bond did return, and the system stabilized. But this story leaves us with a pretty important question to chew on. What's the next quiet, technical little change that's waiting in the wings right now that could shake our financial world in ways we can't even begin to imagine? Now that's something to think about.